Welcome to the deep dive. Today, we're plunging into, well, a fascinating high stakes world. Central banks are practically walking a tightrope.
That's
On
right.
one side, they're battling inflation. On the other, they're trying to keep the entire financial system from, wobbling.
The tricky balance.
And our focus, a really pivotal speech from Andrew Bailey, the governor of the Bank of England. He gave it recently in Kyiv.
That's the one.
And it's a speech that sounds like it has pretty profound implications for the Bank of England's strategy and maybe most critically for the British pound. So we're going to sift through a whole pile of expert analysis, dissect the market reactions, maybe even sprinkle in some intriguing economic theories to really get our heads around what's being called Bailey's Doctrine.
Yeah, sounds good.
Think of this as your shortcut, hopefully, to truly understanding this pretty complex situation.
That's exactly right. Our mission here in this deep dive is really to pull out the absolute most important insights from all the source material you've gathered. We'll try to connect the dots between what might seem like, separate events and help you understand not just what happened, but why it genuinely matters for global finance. And maybe even for your own perspective on economic stability.
Okay, let's unpack this right away then. So, at the heart of this whole discussion, what exactly is Andrew Bailey trying to tell us? What is this doctrine that could, well, shake things up?
Well, fundamentally, Bailey's doctrine signals a really significant shift. Maybe even radical, you could say, in philosophy for the Bank of England.
Right.
He argued quite clearly that monetary stability, which, for central banks usually means controlling inflation and financial stability. So ensuring the integrity, the smooth running of the financial system are equally important.
Equally.
Equally. He called them inseparable, stated emphatically that no objective can be adequately achieved if the other is not fulfilled.
Yeah.
Now, this is quite different from the more traditional view.
Yeah,
Right?
usually it's inflation first.
Exactly. Inflation control almost always took primary, sometimes even the only, focus. So this isn't just a small adjustment. It's like a foundational tremor.
Wow.
Bailey's effectively saying that, but we might, let inflation run a bit hot rather than risk a systemic financial meltdown. That's a pretty radical departure. Signals a new era, really, for central bank priorities.
That feels like a monumental shift. I'm genuinely curious, beyond the sort of headline statements, what were the real whispers, the undertones in that speech? Because it feels like there's maybe more going on.
Oh, absolutely. The subtext is crucial here. First, this idea of no hierarchy.
Okay.
It means the BOE won't chase its 2% inflation target at any cost if doing that puts the financial system's stability at risk. It's a clear signal. Systemic health might trump hitting that exact number right away. Second, Bailey kept mentioning non-bank financial institutions, NBFIs.
Yes, the NBFIs.
Right. Basically, big players like pension funds, hedge funds, operating outside the usual banking rules. They were right at the center of that 2022 gilt market crisis, remember?
Oh.
And he also brought up new tools, like the Contingent Non-Bank Repo Facility, the CNRF.
CNRF.
Yeah, think of it as a sort of specialized emergency lending window just for those shadow banks. It's a direct lesson learned from that 22 crisis. Shows that Bowie's watching that, often opaque, part of the system very closely now.
Got it.
Third, despite this dual focus, he still emphasized the inflation target, called it a nominal anchor.
Okay, so not throwing it out completely.
No, not at all. He highlighted that this framework has proven its value in handling severe shocks, which was maybe a subtle pushback against critics saying the Bowie lost control over inflation. He's saying, we still value it, just not, at the expense of everything else.
Right.
And finally, and this is really key for understanding their future moves, the speech implied an asymmetric reaction function. We call it a dovish skew.
Dovish skew. Explain that a bit.
Essentially, it means the Bowie has a, let's say, heavier finger on the pause or cut rates button when financial stress pops up, even if inflation isn't perfectly back in its box. It's like they'll prioritize stopping the house from falling down over, perfectly tidying the living room right that second. They're more likely to ease policy if the system wobbles, rather than tightening further just to fight moderate inflation when things are already strained. That's a huge factor for predicting policy.
So, if financial stability is equally important now, what did this mean for the markets right away? How did they react? Markets are always the judge. Right?
Oh, yeah. And the immediate reaction wasn't just about Bailey's speech, interestingly. It actually coincided with some pretty big geopolitical news.
Oh.
Specifically, the announcement of a ceasefire between Iran and Israel. And that news triggered a really strong risk-on shift across markets.
Okay. So walk us through those immediate first-order effects on the currencies then. What actually moved and why?
Well, that risk-on shift basically meant investors felt braver all of a sudden. They started pulling money out of safe assets, like the US dollar, and putting it into things perceived as riskier.
Which includes the pound.
Which definitely includes the pound in that context. So we saw the US dollar weakening pretty much across the board. Consequently, GBP USD cable, it strengthened, bounced back sharply from a one-month low, and started testing 1.36 Hungado.
Okay.
Similarly, the pound strengthened against the euro. So URGBP weakened, dropped below 0.8550. That was also helped a bit by some stronger than expected UK PMI data that came out around the same time.
Right, the manufacturing data.
Exactly. And the risk-sensitive GBP-JPY pair, it rose sharply, headed up near 198.20 as demand for the safe haven Japanese yen just evaporated.
And UK gilts, government bonds.
Their yields likely decreased,
Fair.
along with U.S. Treasury yields. Again, mostly driven by that positive ceasefire news, creating that risk-on mood.
But the plot thickens, doesn't it? This isn't just about the day's reaction, it's about the deeper ripples. What are the second and third order effects?
Yeah.
The longer term stuff from Bailey's doctrine in these shifts.
You're absolutely right. The immediate reaction just kicks things off. In terms of second order thinking, the market's now sort of reassessing the BOE. While their recent vote to hold rates at 4.25% looked, hawkish on the surface, Bailey's message suggests a lower bar for cutting rates if financial stress emerges.
So potentially more dovish than they look.
Potentially, yes.
Yeah.
And that could support UK stocks, especially sectors sensitive to interest rates. Maybe narrow corporate credit spreads, a weaker US dollar, a stable pound might also attract some short-term money back into UK assets.
But there's a catch.
There's a big caveat. The underlying stagflation narrative, that combo of stagnant growth and sticky inflation, that's still a major hurdle for long-term investors. It hasn't gone away. Now, for third-order thinking, the unintended consequences. This is where it gets really insidious.
Okay.
If markets start believing that BOE will always step in to prevent financial instability, you could get what's called a BOE put risk.
Like the old Fed put.
Exactly like that. And here's the really tricky part. By trying to be the safety net, the BOE might accidentally encourage more reckless behavior in that NBFI sector, increasing the very risks Bailey is worried about.
Wow, so classic moral hazard.
Writ large, across the whole UK financial system, potentially. It could even lead to a bigger future crisis that maybe the current tools can't handle.
So wait, that sounds incredibly serious. The act of preventing instability could actually breed more instability down the line.
That's a very serious concern, yeah.
Yeah.
And furthermore, this doctrine really elevates the importance of the UK government's fiscal policy.
How so?
Well, imagine any perceived fiscal irresponsibility, like big unfunded spending promises. That can trigger a gilt market sell-off, right?
Like we saw before.
Exactly. And that would then force the BOE to intervene purely for financial stability reasons, no matter what the inflation picture looks like.
So fiscal policy starts driving monetary policy.
Precisely.
Yeah.
Which is highly unusual and potentially very unstable. And if the BOE keeps getting forced to choose financial stability over its inflation mandate, it could eventually de-anchor long-term inflation expectations. Makes future inflation fights much, much harder and more costly. All of this just significantly increases the UK's vulnerability. Think about a global risk-off event. It could spark a financial stability crisis through that NBFI gilt channel, forcing the BOE into dovish moves, rate cuts, QE, even with high domestic inflation, a potential stagflation spiral, and a collapsing British pound. It's a grim scenario, but it's a possibility inherent in this new doctrine.
What's truly fascinating here is how the UK's situation stacks up against other major economies right now. When you look at the dashboard, the macro picture, how does this policy divergence look?
Well, it immediately highlights a core policy divergence, yeah. For the UK, you've got the highest inflation among the majors, 3.4% headline, 3.5% core, a whopping 4.7% services inflation.
Ouch.
But a fragile economy, only 0.7% GDP growth.
Yeah.
So that creates a really difficult trade-off for the BO, sitting there with a 4.25% policy rate.
And elsewhere?
Contrast that with the U.S. robust economy, inflation closer to 2%, solid jobs market. That allows the Fed to be patient, holding rates between 4.25% and 4.50%. And then the Eurozone. Lower inflation, 1.9% headline, 2.3% core. That's already given the ECB room to cut rates, down to 2.15%. So the UK, it's really in a uniquely difficult spot, a genuine pickle for the BOE.
This raises a really important question. How do market expectations fit into all this? Can they actually shape reality? I mean, if everyone expects trouble, does that make trouble more likely?
This is exactly where something called reflexivity theory comes in. It's a fascinating idea.
Go on.
It suggests that market expectations about Bailey's doctrine, the very belief that the BOE has a low tolerance for financial stress, can themselves push up borrowing costs for the UK government and companies.
Oh.
Because lenders demand a higher premium for the perceived risk and higher borrowing costs. They slow the economy further, stress the financial system more, validating those initial fears.
So the narrative becomes self-fulfilling.
Exactly. That narrative of a stagflation trap can literally become a self-fulfilling prophecy if it scares off investment and weakens growth. Makes the BOE's job even tougher. It's a feedback loop, and they can be very hard to break once they start.
Let's talk about the mood on the street then, market sentiment. Is it still all, risk-on positivity after the ceasefire news, or is there something else brewing underneath?
Well, Bailey certainly tried to shift the narrative, didn't he? From Bowie behind the curve on inflation to prudent guardian of overall stability. But the dominant story, it still seems to be UK stagflation. Yes, the ceasefire news gave a temporary boost, shifted sentiment towards risk on, which is good for the pound short term. But that feeling is fragile. The focus on Bailey's dovish asymmetry, the weak underlying economy that pushes markets towards risk off, especially for UK assets. So current price action might reflect the ceasefire relief, but that negative undercurrent is powerful and could resurface very quickly.
And what about the actual positioning, the quantitative data?
Right. If we dig into the raw market positioning data, like the CFTC report, it tells a diverging story. Large speculators, fast money hedge funds, they're heavily betting for the pound. They're crowded, a lot of people holding the same bet.
Okay, but what about the other side?
Here's the kicker. Commercial traders, the smart money, corporations actually doing business, hedging real risks, they're significantly betting against the pound. They're net short.
Whoa. So the speculators are long, the commercials are short.
Exactly. And that creates what traders call a compressed spring. It's a situation where if you get any kind of negative catalyst, a dovish signal from the BOE, weak economic data, you could see a rush for the exits from those crowded long positions.
And not enough buyers.
Potentially not enough natural buyers to absorb the selling, which could lead to a rapid, maybe even severe GBP sell-off. That's a major downside risk sitting there.
Wow. Okay, so we have the fast money betting one way, the smart money betting the other, like a compressed spring. That sounds precarious. So how does this all translate onto the trading screens? What are the key battlegrounds, the specific currency pairs to watch?
Okay, first, GBP USD. Cable. This is really the primary battleground. It pits the BE's stagflation problem against the Fed's data-dependent approach. And it's super sensitive to global risk sentiment because the US dollar is the main safe haven.
Key levels there.
We're looking at key support around the 1.3400 mark and resistance up between 1.3600 and 1.3700 mark.
Okay, what else?
Second, EUR GBP. This crosspair is maybe the purest way to see the policy divergence between the BOE and the ECB.
Because the ECB is cutting and the BOE isn't.
Exactly. The ECB's already started cutting rates. BOE is holding because of that higher inflation. In theory, that should mean EUR GBP trends lower or the pound gets stronger against the euro.
But there's always a but.
But the weaker growth outlook for the UK compared to a maybe stabilizing eurozone could cap the pound's upside there. It's not straightforward.
Got it. And the third one?
Third, GBP-GPY. This one's often called the ultimate risk gauge for the pound.
Why is that?
Because it combines the specific UK fundamentals, BOE policy, economy with global risk appetite, using the Japanese yen as that key risk indicator. It's highly volatile.
So risk on, it flies. Risk off, it dies.
Pretty much. In a risk-on world, GBP-JPY tends to rise sharply. In a risk-off panic, it's likely to fall, potentially quite dramatically.
Okay, so with all these complex forces swirling around, how do we even begin to think about what happens next? What are the possible scenarios? Let's use our tree of thought model.
Right. Our model outlines 3 distinct scenarios. First, the bullish scenario. We call it the sterling haven.
Right.
We give this about a 30% probability.
Okay, what does that look like?
This assumes a kind of global Goldilocks situation. Inflation falls nicely everywhere. Central banks can ease policy gently. The UK avoids recession. Its inflation falls convincingly, allowing the BE to keep rates relatively attractive. That could draw in carry trade money.
And for GBP USD?
In that world, you'd likely see GBP USD moving up, maybe above 1.3750.
Okay, scenario 2.
Second, the bearish scenario, the stagflation trap.
Yeah.
We assign this the highest probability, 45%.
The most likely one, then. What happens here?
Here, the UK's domestic economic weakness just becomes undeniable. But that sticky service inflation stops the BA from cutting rates. They're paralyzed. Combine that with a resilient U.S. economy keeping the Fed on hold, and you get a sharp repricing of UK assets. A pound sell-off, likely made worse by that crowded speculative long position unwinding.
The compressed spring uncoils.
Exactly. Our key target for GBP/USD here would be down below 1.3210.
And the third possibility?
Finally, the sideways complex scenario. We've dubbed it the geopolitical quagmire. About a 25% probability. Meaning basically no clear direction. Geopolitical news flares up, causing strong but short-lived risk-on, risk-off moves. Economic data from both the UK and US is inconsistent, offers no clear signals. Currencies just get stuck chopping around in broad volatile ranges.
And the range for cable?
For GBP/USD, probably somewhere between 1.3350 and 1.3650 in that scenario. Just messy.
Okay, so summing all that analysis up, what's the most likely path forward according to this deep dive? And crucially, what should we be looking to do? What's the strategic takeaway?
Based on everything we've looked at, the most probable path does seem to be that bearish scenario, the stagflation trap, with that 35% probability.
And the reasoning, just to recap.
It's really rooted in three core pillars. First, the underlying UK economic weakness. The economy just looks fragile under these high rates. Second, that stark policy divergence, especially with the stronger US giving the Fed the luxury of patience the GOE might not have. And third, that vulnerable, crowded, long, speculative position in sterling futures. That compressed spring is a real source of potential selling pressure just waiting for a trigger.
So, if that's the most likely path, what's our actionable recommendation? What's the play?
Okay, so the recommendation flowing from that analysis is to look for opportunities to establish a short position on GBP/USD.
Go short, Cable. How?
Well, for an entry strategy, we'd suggest waiting for a confirmation signal. Ideally, maybe a daily close below that key psychological and technical support level of 1.300. That also happens to line up with the 50-day moving average right now.
Okay, wait for the break below 1.340. End targets.
Initial price target would be the technical support around 1.3280. A more aggressive second target could be the psychological level of 1.3200.
And crucially, risk management. Stop loss.
Absolutely essential. Place a stop loss order above the recent resistance levels and those geopolitical highs. Somewhere above 1.3650 seems sensible. That defines your risk clearly against the potential reward.
That's a very clear strategy layout. But nothing's certain, right? What are the key things that could completely invalidate this analysis? What are the big risks that would tell us, hang on, this bearish view might be wrong? What could throw a wrench in the works?
Good question. There are definitely risks. 4 key invalidation points come to mind. First, a genuine global soft landing. If that bullish scenario actually happens, growth holds up, inflation falls globally, our bearish thesis is just wrong.
Okay.
Second, an unexpected dovish pivot from the Fed. If U.S. data suddenly tanks and the Fed starts signaling aggressive rate cuts, the dollar would weaken sharply, killing the short GBP/USD trade.
Right, U.S. rates matter hugely.
Third, a surprising and rapid UK inflation shock. But to the downside, if UK inflation suddenly collapses much faster than anyone expects, that gives the bill baby loads of room to cut rates, potentially sparking a relief rally for the pound.
Unlikely, but possible.
Possible. And finally, major geopolitical escalation. A sudden reversal, things getting much worse in the Middle East or elsewhere. That could trigger totally unpredictable safe haven flows that just swamp all the other economic factors.
What a dive into this really intricate world of central banking, market mood, geopolitical ripples. It's amazing how one speech can potentially set off such a chain reaction across global markets, shaping the future for the pound.
Absolutely. And the takeaway for you listening is this. Understanding these nuanced priorities of central banks, especially now in this world of complex shocks. It isn't just for traders anymore.
No,
it's crucial for understanding the underlying health, the vulnerabilities of major economies in real time, and how all these factors interact on a global stage. It really matters.
So, maybe here's a provocative thought for you to mull over until our next deep dive. If financial stability truly becomes an equal priority for central banks alongside inflation, does that create a whole new kind of moral hazard? Could, paradoxically, end up encouraging the very risks in the financial system that might eventually lead to even bigger crises down the line? Something to ponder.